What's good, YouTube? And we're back with another video. It's the financial chapter. Now, there's a lot of myths around credit scores, and we're going to clear the air on some of those in this video. Your credit score is basically a report card for adults that shows how responsible you are with the money that's lent to you. The most common credit score is the FICO score, which is named after the Fair Isaac Corporation. A person's FICO score helps lenders such as credit card companies, auto dealers, and mortgage bankers help evaluate the risk of extending credit or loaning money to people and at what interest rate. So when you're able to show a bank that you can pay back money responsibly, they're more likely to give you better interest rates. So on the flip side, the lower your credit score is, the more expensive things start to become and the higher the interest rates get. Your credit score is generally graded on 5 different factors, and we're going to go over all 5 in this video. But just to keep in mind, the 2 most important ones is your payment history and your credit utilization. And before we get into this video, I'm just sharing my ideas on credit scores and what I do personally. And always remember that investing is all about, remember to do your own due diligence. First, let's go over payment history, which accounts for 35% of your FICO score. Your payment history is exactly what it sounds like. It's whether you've paid your bills on time or not. And for the lenders who are considering lending you that money, they're really just going to be asking themselves, am I actually going to get my money back here? So the best way to approach your payment history is to basically just pay off your bills on time every single month. Simple steps such as autopay can help you pay on time, and it protects your credit score. So what I like to do is I at least set my automatic payments for my credit cards to a minimum of $25 every single month. Because what you don't want to happen is end up with late fees. And in addition to that, payments that are 30 days or more late can end up damaging your credit score. But if you're not a fan of automatic payments and you're afraid of getting overdrafts or something like that, you can always just set up some calendar reminders and put it on your iPhone. It's as simple as that. You can also just contact your lender and ask them to move your due dates to a specific date that's more beneficial to you. And by the way, I know that a lot of people think that you might need to charge a lot of money into your card in order to help boost your credit. Keep it simple. Just put small purchases on there. Maybe if you have a phone bill or something like that, you can make that be reoccurring every single month, and you just pay that off. You don't need to go out there and go buy a Lexus or something like that, or I don't even know if you want to. You just don't need to do that. Now, the second most important factor is your credit utilization, which accounts for 30% of your FICO credit score. Now, FICO scoring considers your credit utilization ratio, which measures the amount of debt you have compared to your available credit limits. In other words, how much of your available credit are you actually using? For example, say you have absolutely no loans and a single credit card with a $250 balance with a limit of $1,000 on that credit card. Your credit utilization would be 25%. Now, experts say that it's best to keep your credit utilization under 30%. For me, I like to keep it under 10%. Now, you can reduce your credit card utilization in one of 2 ways. The first would be to just get more credit, and you do that by opening up new accounts. Now, the second way would be to actually just increase your credit limit on your current accounts, or to just pay off your existing balances. If your credit card companies allow you to set alerts, ask to be notified when you're approaching your 30% credit limit. Now, if you can afford to, try paying off your balance in small chunks during the billing cycle as opposed to waiting until the end of the month. This would help keep your credit utilization low instead of it building up and reaching a certain peak. But to wrap this all up, credit bureaus want to see that you aren't maxing out your credit cards and that you're keeping a relatively low balance compared to the overall credit that you have available to you. The good news is having credit score damage due to high credit utilization can actually be reversed. Once you pay a high balance down, the creditor reports it to the credit bureaus and you start to see some more recovery in your credit score. The third factor is to look at your credit history, which accounts for 15% of your FICO credit score. Now, your credit history is different from your payment history. Your credit history is actually talking about the length of time that you've actually had credit accounts. When it comes to the age of your credit accounts, there are 2 main factors that a lender looks at. The first would be the age of your oldest account, and the second is the average age of your combined accounts, which is calculated by adding up the age of each account and dividing it by the number of accounts that you have. Your credit score benefits by having accounts showing a long record of responsible use. So keep those old credit cards open unless there's a good reason why you should actually close it. For instance, maybe like a high annual fee or something like that. Now, a good trick for this is to just become an authorized user on an already old account that has an excellent payment history. So maybe someone like your parents or something like that. My recommendation to the youths is to just start building your credit as soon as possible and make sure that they stay in good standing. Now, the fourth factor is the total number of credit lines, which accounts for 10% of your FICO score. There are two types of credit accounts that are involved. One would be revolving debt, aka your credit cards, and the other would be installment debt, which is also known as your car loans or your mortgage loans. One of the benefits of having a mix of credit types, such as an auto loan and a mortgage loan and credit cards, is that it shows the lender that you're capable of handling multiple different types of loans without defaulting on them. The second is the more credit lines you have, the higher your credit limit, which lowers your credit utilization. But with all of that being said, you should only be opening up new credit as they fit your financial need. Eventually, over time, as you get older, you'll start to develop a mix yourself, so there's no need to rush. Now, the fifth and final factor is the number of credit inquiries, which accounts for 10% of your FICO score. Each time that you submit an application that requires a credit check, that inquiry is placed on your credit report. Now, there are two types of inquiries that can be performed. There's soft inquiries, and then there are hard inquiries. Now, soft inquiries don't affect your credit score. They typically occur in situations where you check your own credit, or when a lender or a credit card company checks your credit to pre-approve you for an offer. With that being said, check your credit score every few weeks. Some banks offer the option of checking your credit score within their apps, one of those being the Chase app. But before doing so, make sure that you read the terms and conditions before you agree to do anything. Hard inquiries, on the other hand, do affect your credit score, and they appear on your credit report. Whenever you apply for a new line of credit, such as a credit card, lenders typically do a hard inquiry. This helps lenders keep track of how many times you're going out and asking for credit. Too many hard inquiries in a short period of time could actually be considered problematic to some lenders. That's because multiple hard inquiries can give the signal that you're opening up numerous new accounts. And when you have several new accounts, that might just indicate that you aren't able to pay off your bills or that you're having some sort of financial issues. It could also just mean that you're more likely to start overspending. So as a result, hard inquiries have a temporary negative effect on your credit scores and can cause a small and temporary decline in your credit score. However, there are some exceptions when you are rate shopping for the best deals. According to Experian, most credit scoring models will consider multiple inquiries for a certain kind of credit product, such as a car loan or a mortgage, in a short period as a single inquiry, which will have a smaller impact on your credit score than multiple separate inquiries. So to wrap this all up, following these simple guidelines can help you build and maintain a good credit score. But if you only remember 3 things from this video: pay off your bills on time, only use 30% of your available credit, and hit the like button for the YouTube algorithm. I hope this video was helpful for some of you watching. Like, comment, and subscribe. Let me know what other videos that you'd like for me to do in the future. And look forward to seeing you guys at the next vid.